welcome to the deep dive. We've got a really interesting pile of reports and articles all about crypto and taxes, especially with, all these tokenized assets popping up.
Yeah, it's definitely a hot topic.
For sure. And it feels like things are changing so fast, it's hard to keep up. So
Right.
that's why we're here. To break it all down, we're mainly diving into this PWC report, and it highlights some fascinating trends. Like, for example,
Okay.
it predicts that by 2030, we could see something like 5 to 10% of all assets
Wow.
tokenized.
Yeah.
That's almost $20 trillion. Like everything from real estate to artwork.
Right. Like everything could have like a digital twin on the blockchain base.
Exactly. Which is, obviously a huge shift. So it's not surprising that tax authorities are like taking notice.
Yeah, they're definitely paying attention. It's like they're realizing the old rules just don't work when it comes to crypto and these tokenized assets.
Exactly. And that's where things get really interesting. Like, for example, the report talks about this thing called QRF,
Yeah.
the OECD's crypto asset reporting framework.
Right.
And they say it's a total game changer. And this isn't just some, regional regulation. It's like
Right.
a global effort to bring transparency to the whole crypto space.
Yeah, it's like they're, governments are recognizing that crypto is here to stay, right? So they're moving beyond just trying to shut it down, and instead they're focusing on creating a framework for, for tax compliance.
So it's like the Wild West of crypto is finally getting some sheriffs in town.
Exactly. And those sheriffs are coming in with all these new data analytics tools that can track transactions, all over the world.
Wow.
So like one of the key aspects of QRF is it focuses on information sharing between different countries' tax authorities. So if you're thinking about like moving your crypto around to avoid taxes, think again.
Okay, so no more hiding your digital gold under the virtual mattress.
Not if you want to, stay on the right side of the wall.
Right, of course.
And here's something that's interesting. It's not just about, going after the big whales. Like, this has implications for everyday crypto users, too.
Oh, really?
Yeah. Like, did you know that under CARF, even retail payments that are over $50,000 in crypto, those could be reportable?
$50,000. That's a pretty high threshold.
Right.
Like, what kind of transactions would even fall under that?
I mean, it could be anything, really, like buying an expensive NFT or making, a large purchase using Bitcoin. The point is tax authorities are, casting a wide net. They're not just relying on people to self-report anymore. They're going to be getting, data from exchanges and those kinds of service providers.
Oh, wow. Okay, so if I'm thinking about getting that virtual Lamborghini, I better make sure I'm keeping really good records.
Absolutely. And it's not even just about avoiding penalties. Like, as crypto matures and becomes more, integrated with traditional finance, having accurate records can actually help you. It can make things like applying for a loan or, proving your financial history a lot easier.
It sounds like transparency is really the name of the game in the future of crypto.
For sure. And speaking of transparency, let's talk about how CRF addresses stablecoins, because this is where it gets a little more.
Yeah. Stablecoins are becoming super popular. So how do they fit into this whole tax crackdown?
Well, it's interesting. While CRF is creating a new reporting framework for, most crypto assets, it actually puts stablecoins in with the existing regulations for traditional finance, specifically the Common Reporting Standard, or CRS.
So even though they're built on a blockchain, they're treated more like, like bank deposits and stuff?
Yeah, it seems like that's where things are going. I think it shows how policymakers are trying to deal with the fact that stablecoins kind of blurred the lines between crypto and traditional finance.
It makes sense. Like, they don't want to create a whole new set of rules for something that basically works the same way as the systems we already have.
Exactly. And this approach might even have some interesting effects on financial innovation. Like, if stablecoins are treated more like traditional assets, it might make them more attractive to big investors, or even just everyday people.
So this could be like a good thing for stablecoins in the long run.
It's possible, yeah. Of course, there are still a lot of questions about, how they'll be regulated long term. But the fact that CRF acknowledges that they're different, it's definitely a step in the right direction.
Right. So CRF is setting the stage for like a more transparent and regulated crypto ecosystem.
Yeah.
But what about other countries that are already like pushing ahead with their own crypto tax rules? Like, what's the EU doing?
Well, the EU already has something called DAC8, which is basically their version of AIR.
DAC8, what does that stand for again?
It stands for the Directive on Administrative Cooperation in the Area of Taxation. It's their way of, aligning with CRRF, but they've actually gone further in some areas.
Really?
Yeah, like DSC8 specifically talks about the tax treatment,
What?
things like staking and lending in the crypto world,
Oh, interesting.
which are becoming increasingly popular. And these things are often overlooked in traditional tax codes, so the EU is really trying to get ahead of the curve.
So it sounds like they're trying to cover like all their bases when it comes to, crypto tax compliance.
They are. And honestly, this approach might even give them an edge in attracting
Interesting.
crypto businesses and investors.
It's like a race to become the most crypto-friendly jurisdiction.
Uh-huh.
But we can't forget about the U.S. They're usually, kind of at the forefront of, everything. What are they doing about crypto taxes?
Oh, the U.S. is definitely in the game. The Treasury and the IRS have proposed their own set of regulations, and they're pretty intense.
Okay, give me the details. What are they proposing?
Well, one of the big ones is expanding the definition of broker in the crypto world. Like, they want to include things like digital asset, payment processors, and even some digital wallets.
Wait, so if I use a certain digital wallet to manage my crypto, I could be considered a broker by the IRS. That seems like a bit much.
Yeah, a lot of people in the crypto space are worried about that.
Yeah, I can imagine.
It could create a huge compliance burden for companies and individuals who are just trying to, participate in this new ecosystem.
And what about, the IRS's ability to even handle all this new information?
Right.
Like, we're talking about millions of transactions every day.
It's a ton of data. They estimate they could receive something like 8 billion 1099 DA forms.
8 billion.
Which are specifically for reporting these digital asset transactions.
Wow, that's a lot of paperwork. How are they even going to process all that?
Well, the IRS is investing in, data analytics and artificial intelligence to help them sift through it all.
Okay.
And this is where the cloud comes in.
How do clouds and taxes even mix?
Well, the cloud can handle huge amounts of data, right? So companies can use it to store transaction records, automate tax reporting, and even run, what-if scenarios.
So instead of being buried in spreadsheets, companies can just use the cloud to streamline everything.
Exactly. And the IRS can use the cloud to, aggregate data, identify patterns, and even do personalized audits.
So it's like a digital arms race between the taxman and the taxpayer, with the cloud as the ultimate weapon.
It's definitely a powerful tool, but it's important to remember that technology is only part of the solution. We still need, clear regulations, consistent enforcement, and just open communication between policymakers and the crypto community.
It's such a complex and evolving landscape.
It is.
But before we dive even deeper into the tax implications, we should probably shift gears and talk about tokenized real-world assets.
Sounds good to me.
That's next.
All right.
Stay tuned.
Oh.
Welcome back to the Deep Drive. So before the break, we were talking about KRF and DAC8 and the global push for more transparency when it comes to crypto taxes.
Yeah.
But now I want to talk about something that honestly sounds like it's straight out of science fiction.
All right.
Tokenized real-world assets.
This is where things get really interesting.
Yeah,
from, both a tech perspective and a tax perspective. Imagine owning a piece of a famous painting or a slice of a skyscraper in Manhattan or even a share of a racehorse.
Through a token on the blockchain.
Exactly. That's the potential of tokenized real-world assets or RWAs.
Okay, so how does this even work? How do you turn a, physical object into a digital token?
So you start by creating a digital representation of the asset on the blockchain.
Okay.
Think of it like a digital twin. And then this token can be divided into smaller units, which makes it possible to own just a fraction of an asset.
So instead of needing millions of dollars to buy a Picasso, I can buy a token that represents a tiny percentage.
Exactly. It opens up all these possibilities for fractional ownership.
That's really cool.
Especially for, things that were just too expensive before.
Yeah, that makes sense. But the big question is, how does this affect taxes?
That's a great question. And to be honest, that's where things get a little murky. The tax treatment of these tokenized RWAs is still, being figured out.
Right.
And it really depends on a lot of things.
Like what?
Like the jurisdiction, the type of asset, even how the tokenization was structured. There's no easy answer.
So it's like the Wild West of taxes all over again.
Uh-huh. Yeah, in a way.
Can you give me an example? Like, let's say I buy a token that represents like a share of a rental property.
Uh-huh.
Would I be able to, deduct things like property taxes and maintenance costs?
That's a great question, and it really shows one of the main challenges here.
Okay.
Because in some places, you might be able to.
Okay.
But in other places, the rules might be totally different. It could depend on if the token is considered a security or a digital asset or...
So it's not as easy as just like applying the old rules to these new tokens.
Exactly. We're dealing with a whole new type of asset.
Right.
And it's forcing everyone to rethink how we define things.
This is complicated.
It is, yeah.
So what are like some of the other challenges facing, both individuals and governments?
Well, one big one is figuring out the place of supply. The blockchain is global, so it can be really hard to say where a tokenized asset is located.
That makes sense.
For tax purposes.
Yeah.
Is it where the actual asset is?
Okay.
Where the token was issued?
Okay.
Where the token holder lives? These are all questions tax authorities are trying to answer.
It's like trying to nail jelly to a wall or something.
Uh-huh. Yeah, pretty much.
And like this lack of clarity, that probably creates opportunities for like tax avoidance. Right.
It can create loopholes and inconsistencies.
Right.
So for our listeners out there who might be, thinking about dabbling in tokenized assets, what advice would you give them?
That's a good question.
The PWC report actually lists a bunch of questions.
Okay, cool.
That potential investors should ask themselves.
Like what?
Like, how is this token categorized for accounting?
Okay.
What are the reporting requirements in my country? What legal protections are there? Those are all things you need to figure out.
So due diligence is even more important here
Absolutely.
than with traditional investments.
Yeah, buyer beware is definitely still relevant.
All right, so we've got global tax crackdowns.
Right.
We've got these tokenized assets and a lot of uncertainty about, how to tax this whole new world.
For sure.
What's next?
Well, we can't talk about the future of finance without talking about stablecoins.
Okay.
And tokenized money. These are the things that could, completely change how we pay for things.
I'm ready. Let's dive in.
All right.
Welcome back to the deep dive. We've been talking about all these crazy changes happening in the world of crypto and taxes.
Yeah, it's a lot to take in.
For sure.
Yeah.
But now I'm really excited to talk about stable coins and tokenized money because this could, completely revolutionize how we think about money and, paying for things.
It really could.
So these stable coins, they're becoming really popular, but how are they different from, Bitcoin, for example?
Yeah, that's a good question. So Bitcoin and, a lot of those other cryptocurrencies, they're mostly seen as investments, right? Their value goes up and down all the time.
Yeah, for sure.
But stable coins are designed to stay stable. That's why they're called stable coins.
Okay.
So that makes them more useful for, everyday transactions.
So they're kind of like the digital equivalent of, the cash in my wallet.
Exactly. But, of course, just like with physical cash, we have to figure out how to tax them.
Right, because...
And that's actually trickier than you might think.
Oh, really? Why?
Well, for example, what happens when the stablecoin's peg fluctuates, even a little bit?
So even though they're supposed to be stable, there's still, a chance they could lose value.
Yeah, we've seen it happen. And so then the question becomes, do we treat that like a capital gain or loss? And how do you even track that for taxes?
It sounds like a headache for everyone involved.
It definitely adds some complexity.
Yeah.
And the PWC report really emphasizes this as an area where we need more guidance from, policymakers and regulators.
Okay, so we've talked about stable coins.
Right.
But the report also mentions these things called tokenized bank deposits and tokenized money market funds. What are those?
So basically, these are digital versions of traditional financial instruments, but they're on the blockchain.
So it's taking something that already exists and putting it on the blockchain.
Yeah, exactly. So for example, a tokenized bank deposit would be like a token that represents money in your bank account.
So it's like having your checking account on the block.
Right, exactly.
Wow.
And a tokenized money market fund is similar. It's a token that represents a share of a traditional money market fund, but it's traded on a blockchain platform.
So it's like everything's moving to the blockchain.
Pretty much.
What are the advantages of doing that?
Well, one big one is efficiency.
Okay.
Tokenized assets can be traded and settled way faster than traditional assets, and they can be accessed by more people.
Oh, interesting.
Regardless of, where they live or how much money they have.
So tokenization could make financial services more accessible to, like, everyone.
It has that potential, for sure.
Right.
But just like with stablecoins, we need to think carefully about the tax implications.
Right.
So for everyone listening, what are like the main takeaways?
Yeah, good question.
From all this? I think the most important thing is this is all changing so quickly.
Right.
And the rules are constantly evolving.
Right. Yeah.
So we need to stay informed.
Absolutely. Tax laws and regulations are trying to catch up with all the innovation. It's like playing a game where they keep changing the rules in the middle of it.
Yeah, kind of. That's why it's so important to talk to tax professionals who really understand this stuff.
Right. To help us navigate all this?
Yeah.
What, stood out to you the most?
That's a good question. I think it's just the incredible speed of innovation in this space. It's clear that we're just at the beginning of what's possible with blockchain.
For sure.
And the way we think about, finance, money, even taxes.
Yeah.
It's all going to change in the next few years.
It's both exciting and, a little bit scary.
I know, right? But it's definitely fascinating.
Well, thanks for joining us on this deep dive into the world of crypto and taxes.
Yeah, thanks for having me.
We hope you learned something and maybe had your mind blown a little bit.
Hopefully.
Until next time, stay curious.